Sugar Daddy and Investment Life bring you freedom of financial.
Hello everyone. Today, let me first talk a bit about the market trend. So, overall, the market is showing a slight downward trend, but as we get closer to the market close, starting from noon, the market gradually picked up. The main reason is that there was news circulating all morning saying that US President Trump was making concessions in the trade war. These concessions improved market sentiment, which in turn drove the index to rebound and pushed the index up. At one point, it had dropped all the way down by 20%. Looking back at recent events, the index, the Nasdaq, has fallen by about 4 to 5%. This is largely due to the escalation of the US-China trade tensions. The US planned to first pressure China to lift its rare earth export restrictions before proceeding with further negotiations. But now the situation has reversed, and Trump has directly arranged to meet with Xi Jinping at the summit in South Korea. They're trying to initiate a dialogue. If he cancels it, there's a chance that the 100% tariff originally set to be imposed on October 1st will also be canceled. So, this shift shows that there's more room for negotiation, which is a positive signal for the stock market. In the rest of this video, I'll talk about how to analyze this matter and its impact. But before I get into that, I want to talk a bit about the recent small bank fraud incidents. Recently, there's been news showing that several small banks are involved. Fraud, default, and deceptive acts. The potential amount involved in these frauds or defaults could range from tens of millions to $100 million US. Even though this figure sounds huge, especially from an individual's perspective, the actual impact on the overall stock market is quite limited. Why is that? Actually, the amount isn't really that significant. It's not that big a deal for the market. If you think back to the 2008 financial crisis, when Lehman Brothers collapsed, their defaulted debt reached as high as $500 billion US, not to mention all the CDOs and other derivatives they issued. The total value involved was close to $1 trillion US, and it triggered global risks. In comparison, the problems with today's small banks are like a mosquito bite on a cow, really minor, because the scale is small and the impact is isolated. Unless it sets off some kind of domino effect, it won't spread. For example, let's say a small regional bank defaults. $100 million US. Will this have a direct impact on our local clients? As for the market, it should only take a few days to adjust and then things will get back to normal. But if it involves cross-border derivatives, it could drag down GDP growth by 0.5%. Luckily, the regulators have already stepped in, so the impact is expected to be just short-term volatility, and overall, there shouldn't be much effect on the stock market, right? A major impact? Well, when it comes to the moral hazard issue in these kinds of incidents, historically, after the 2008 crisis, regulations have already been strengthened and are effective. As for investors, actually, they should be paying attention to the banks. If the index doesn't keep dropping, then there's no need to be overly panicked. Alright, so let's get back to the China-US negotiations. Trump being willing to give some leeway is actually a good sign. It at least temporarily eases the threat of tariffs. If both sides truly have the genuine chance to engage in meaningful talk, the core and significant challenge now is that former President Donald Trump has explicitly promised not to raise tariffs for the immediate time being, but there's still a crucial issue coming up next, which needs careful consideration. Can he meet Xi Jinping's demands? Xi Jinping mainly has three demands. First, lifting technology restrictions. China wants to completely remove the export controls on chips. But this is actually quite difficult, because there are strong forces within the US that want to keep restricting China's technological development. Second, it's about completely removing tariffs. removing trade barriers. Third, there's a hidden demand, which is to uphold the One China principle and oppose Taiwan independence. From my point of view, even if Trump does his best, at most he might only reduce some tariffs in exchange for China buying more soybeans. That's the hope. For example, back during the 2018 trade war, the US once suspended a 25% tariff on Chinese soybeans. In return, China promised to buy US agricultural products worth $12 billion US. That helped ease the pressure on American farmers, especially those in the Midwest. Relaxing tech restrictions is much harder, but when it comes to the Taiwan issue, at most, things will just stay as they are. Look, if negotiations succeed and we get a compromise where the status quo is maintained with some relaxation of tech restrictions, that would already be the best possible outcome. In the short term, the stock market could shake off the shadow of tariffs. US and Hong Kong stocks might rebound, and the supply chain could become stable. But looking at the long term, desinicization is still going to continue. Take Apple for example, its iPhone. Gradually, assembly will shift to Vietnam, and it's expected that by 2025, Vietnam's share will reach 20%. Hey, what about the vision of game theory? This one is called Boe. Hey, China is the trump card of rare earths. The global supply accounts for 90%, but its own development requires a lot of American technology. If Trump refused to back down, China might strike back, and the market could drop another 5 to 10%. The recent trade tensions have already caused all the major indexes to fall by about 4%, which really shows that this incident has a definite impact on the market. There's another possibility. Another possibility is what you call the stalling tactic, meaning Trump might postpone the tariffs. As for China taking aggressive action with its rare earth supply, is that a possible path? That's because Trump is facing the midterm elections and wants to avoid inflation. And as for China, they also want to keep stockpiling, right? Accelerating the domestic development of semiconductors. So actually, overall there are 3 possibilities. Let me break it down as 1, 2, 3. The first one, I think the probability is quite low, only about 15% chance. That would be an optimistic outcome. This possibility means that both sides can fully meet each other's demands. In other words, Trump can satisfy President Xi's requirements, and President Xi can also meet Trump's demands. So what about the stock market then? It would surge, it would go up a lot, the stock market would soar. The Nasdaq might jump by 15%, and the Hong Kong stock market could follow with a 10% rise, just like after the 2019 agreement when the S&P went up another 4%. So, what's the second possibility? That is, the possibility of a hardline standoff is about 35%. That means, for example, maybe Trump or Xi Jinping refuse to make concessions, the trade war escalates, the stock market tumbles with increased volatility, and GDP takes a hit, dropping by about 0 something percent, just like at the peak of the US stock market in 2018. It dropped by 8%, and the A-shares fell by 25%. The recent signs of the trade war are all related to this kind of development. So, what do I think is the most likely outcome? That is, well, both sides will drag things out, for example, first agreeing to some of the terms, and then there are twists and turns along the way. Back and forth. So, like this? Right? Both sides are stalling for time. For example, Tariffs due October or November 1st might be postponed, dragged out until year-end, or even January 1st next year. After some back and forth, it fizzles out, nothing gets resolved. If that's the case, the market might. At first, the market might go up a bit, then it would just stay high. It would hold, and the market would fluctuate at a high level. The focus would then shift to company performance, especially the earnings of growth companies. If the company's earnings can hold up, the market will keep going up. But if there are signs of a downturn, the market might see a correction of about 10 to 20%. So, in the short term, is the current stock market being supported by the negotiation window? But the recent few percent drop has also served as a warning to investors. So, for now, I'm sticking to my current approach. Still the same suggestion. Keep some cash on hand first. Hold on to about 10 to 20% in cash, and then see how the situation develops. If, in the end, things just fizzle out, maybe then I'll gradually increase my positions in individual stocks. Yeah, that's what I'll do. I'll add back to those particular stocks that I truly think have a really strong technological moat. Thanks a lot. If you enjoyed today's video, please subscribe and share it.
Please subscribe and follow New York Daddy Investment. Bye.